if you look at this candlestick right here, that open, okay, that price is what I'm anchored to here. You'll see that when we drop down into the 1-minute chart, okay? So we opened here, we traded up into it. That's the change in the state of delivery. And then we started seeing price go lower. Now we'll drop down into 1-minute chart. First hour dealing range. So we opened up here, and let's show the business of regular trading hours. Previous regular trading hours at 4:14. So here is the close at 9:30. We label that regular trading hours open range gap low because it's lower than 4:14's regular trading hours settlement price. Okay. So by adding a fib between these two price points, you'll get the 50% level here, which is consequent encroachment of the opening range gap. That is this. So we have this sell side delivery with the opening price. Gap is shown here, and consequent encroachment always allow for the opportunity for the first, always allow for the potential for price to try to, in the first 30 minutes between 9:31 and 10 o'clock in the morning Eastern time, always anticipate the likelihood, because there's a 70% likelihood that it's going to try to get to the midpoint of that opening range gap. So that's what we were watching yesterday during the live stream. And because it's Friday, it's TGIF, we sold off a little bit. And because of how we've been trading, I was a little bit reluctant to co-sign on a sell-off rate from the opening range gap at 9:30. So I'll take that off. So just know that that's the business. And now we're going to go into regular trading. I'm sorry, electronic trading hours. And this candlestick is going to be our focus right there because that's the 9:30 candle. So we'll go into electronic trading hours. Now, here's that point of reference there. We just have all this extra stuff in electronic trading hours, which is London session and previous Asian session. So we opened here. The gap never got traded to. It just opened and it was gap and go is what they call it. Okay, so it gapped lower. We had to retrace it back in the first percentile fair value gap, which is what I outlined before we even went up into it. But I told you I was a little reluctant into taking any shorts there because I want to see a little bit more detail, a little bit more evidence to suggest that we're likely to keep going lower. Now, if you didn't watch the live stream yesterday, but go watch yesterday's during the first hour of trading from 9:30 to 10:30. Okay, just watch that portion of the recording because you're going to hear me talk about very specific things. So what I'm going to teach today, you'll hear me say live in front of all you that were watching it and were present in the live stream. And then today we're going to teach you what the algorithm refers to, which is the first hour's dealing range. Okay. If you go back and listen to what I was talking about at the time, I was getting indications about how when this formed and we started dropping down, this right here, it could trade up into that. And then when we traded, it started getting heavy. I was wanting to see it, does it have any interest to get to that buy side? And you'll see that's truth. Okay. I wanted to see if they could get there. And then also, I had this one over here annotated. Okay. So there was buy side. This was inside of the opening range gap, which is above this opening price at 9:30, that candlestick at 9:30. Remember, the full gap is there. In regular trading hours, with it being toggled down here, that's the gap now. Okay. So you see it doesn't exist like this because there's all of this price action overnight. See that? So the SIBI here, it started to send price lower. And I was mentioning how it could go below here, but what I wanted to see was I wanted to see it trade below this with a little bit more than just dipping its toe in the water. And the same thing down here. Okay. I wanted to see the first hour's range. And if we look at it like this, here's 9:30 and then 10:30. We'll go to 10:30 and time. There you go. Okay. So there's your first hour's range. It's not the opening range, which is 30 minutes, but this is the first hour's range or first hour's dealing range. How is this useful? How does it benefit us? How do I use it? Well, when we were trading down here, okay, my concern was that eventually we're going to create some kind of a low, which is what I wanted to see. And at 10 o'clock, we had the market have its first 30 minutes. That's this. That's opening range. Okay. The first 30 minutes is opening range. What I'm trying to teach you is if you don't see it like this, you're going to miss some details that are helpful to you. So we're going to go back to 10:30, which is your first hour's dealing range. First business fair value gap, trades up to it, runs a short-term low, trades down, creates a low. Now, first 30 minutes is done. Opening range is done. So now we're going to watch and see what this does. It starts to retrace a little bit. I mentioned this here as a potential inversion fair value gap. And I talked about this becoming a potential inversion fair value gap, okay, or at least drawing up to this one. We saw it meander around in here, finally came up in here, and then traded up into midpoint. Notice where this is forming. So this 10 o'clock high, why am I calling it that? Here's 10 o'clock. After 10 o'clock, what high forms? This. This is the high that the lunch macro will target. If we're down below it and we are entering 10:30 to 11:30 in that vicinity, because it can be a little bit early. Okay, I saw a person leave a comment. Um, you said that lunch is 11:30 to 1:30. Yes, but because things are so skewed, it can happen a little bit earlier. It can happen a little bit earlier. The bleed over from London close. Remember, there's traders participating in all of these markets, and they're closely correlated. So if London's closing up shop around 10 to 11 o'clock our local time and Eastern time, just be mindful that that could create the low of the day or the high of the day. And that influence over price action will be visible inside of the creation of the daily range. Long story short said, when we're looking for a lunch macro retracement target or objectives, we're going to be looking for from 10 o'clock, you would have it like this. Okay. Over here, we're at 1046. So the criteria is there, 1030 to 1130, that little sweet spot. Okay. It can start the lunch macro. But I was talking about how, it could be a macro price run using this gap. And I said that if we can get below, if we can trade below here, like we were doing here, as soon as that candlestick closed right there below that midpoint of this wick, once I did, once we saw that, I said before it did it, this is in many ways a confirmation if you're going to trade the PM session. And I said, I won't be coming back for the PM session, but this tells you, okay, this tells you that the day is going to continue going lower. You can anticipate lower prices in the afternoon. The point I'm teaching is I was telling you that this wick here, if we trade below that on a closing basis, dropping down, as we were making a run just shallow below that low here, and that's all we saw right there. Okay, remember the analogy I talked about a little chihuahua and like this, all this price action is like a big porch, and the chihuahua runs off the deck or the porch. It would meet something to scare it back on the porch, go back inside the range. Okay. And it did that very thing here. So I was telling you to watch this little gap and see if it can use it. And it didn't quite touch it there, right there on that candlestick. This one here, the low. So that's strength. It rallied up. We were watching it pull back a little bit, rallied up again. And right here on this candlestick, it failed to go to that 10 o'clock high as I was calling it live. And I told you that was manipulation. That was good old Phil. Okay. I talked about at the time of this candlestick's forming. Beforehand, I told you that we would probably run below. And if I'm wrong, it'll just keep going lower. But because of the first hour's range, which is what this is, first hour's range low is right there. What have we done since the opening? Right here. We gapped lower, never traded into the gap at all, came all the way down, created a low at 10 o'clock, a little bit of retracement. What's this? That's the halfway point or equilibrium of first hour's dealing range. That also qualifies the macro, lunch macro run to that for a trade. It sells off. The bodies are respecting this gap over here. So this is reclaimed bearish fair value gap there. And then sends us down into that little shallow run below this. So sell side below here, I said live, it's going to probably just go below a little bit and come right back into the range. We don't want to see that if it's going to continuously go lower. But this low, if we have that low taken out here, it'll be shallow. Why would I expect it to be a shallow run below this low and come back into the range? Because this low here forms and we went into 1031. What's established now? The first hour's range. So this low being taken out here on a shallow basis is because we have already established the first hour's dealing range. And it's been one-sided right from the opening bell, lower. Okay. So now, who's making money? Shorts. This drop down here, as I mentioned, that's going to entice people to do what? Chase it on a breakout. Well, it's been going down all morning. It broke support, so it's probably going to keep going lower. What we're doing is we're flipping retail logic upside down and attacking them with it. That's all we're doing. This is how you find wonderful turtle soup setups. Okay? This is the logic behind it. Because we had to close here below that consequent encroachment, that wick, any retracement here sets the stage and tone for the afternoon sell-off. Why would they want to come back and take out this high here? Because stop loss would have been trailed on shorts just above this high. It's also halfway point or equilibrium of the first hour's dealing range. And it also fits the criteria. I tell you that the algorithm will refer back to 10 o'clock. What's the high that forms after 10 o'clock? That's this one when price was down here. It would likely drop to here. This was manipulation. They stopped it dead in your tracks because you all were doing what I told you not to do. You're following me and you're putting your limit orders there. So Phil came in, turned the market around, and took you right into your stop loss if you were trading it. I said this is where I would like to see it support price. If it can't do it, then I would be personally done. I killed the stream the very next minute. Phil took it right back up to there. I told you on this candlestick as it formed live, that right there is what we're looking for. That is the false run. And now we can look for it to get into this here and then go for that liquidity there. That's the lunch macro. Here, when I tell you that's manipulation, that's fill, it pulls back and goes right back into consequent encroachment of that wick. Look where the bodies are. See that? Starts to rally, and in one candlestick, look at the low to high. 1 minute, about 100 handles in 1 minute, straight to the top of that imbalance, which is this candlestick's low. Look at this candlestick's low. The high of this candlestick, oh, I'm off by a tick. Okay, that's still good. It didn't go beyond it. It's inside that range. That's good. Then they used it here. But anyway, they took it all the way up and just fell short of first percent to fair value gap. Is that bullish or bearish? If it turns on a dime and stops and goes lower, is that bullish or bearish? The way I teach order flow, that is bearish. You don't have to look inside candles. You don't have to look at how many people bought or sold around a particular, price level. And then we want to see how this range here get used because it's a sell side imbalance, buy side inefficiency here. While we're above it, it can act as inversion. But if it's resuming going lower, and it's going to do that because we saw price trade below it here on a closing basis, that sets the stage for the afternoon, the PM session, post 1 o'clock Eastern time. Watch what happens, okay? It uses the low of this to send it up there, falls short of the first percent of fair value gap, breaks down below this gap, this one here, which is a SIBI. So this has to go into reclaimed bearish fair value gap, okay? We trade through it, come back up, a little bit outside the lines here, but that's okay. Why is this not problematic for me? What do you see here? A wick and a wick. Wicks are like what? They're like gaps. Okay. We have this consequent encroachment, and we'll look at the full range from there to there. Look where the bodies are in the lower half. If it's bearish, the wicks can color outside the lines. That's you're gonna have to get comfortable with that. Okay, it's not a deal breaker. So it's supporting the idea that these wicks in here were in the lower half of it, even though we had a little bit of a wick here on the upside. The bodies are staying in the lower half of it. Order flow is bearish. The market drops down. Look when we go outside of it. The bodies enter back into this gap over here, this one. If it's bearish, do we want to see the bodies in the upper half or the lower half? We want to see the bodies being buried in the lower half. The wicks can come up here, but they can't drop bodies there. All of them have to be here. So the market sells off, trades back down into the other fair value gap that I mentioned in the live stream yesterday. We trade through it to the downside. We close below it right there. Now, what's going to happen? This is going to become a reclaimed bearish fair value gap. Trade through it, comes back up. Look where the body stops. What's it telling you? Is order flow bearish or bullish? Where's sell side? Here, here, here. What time of day is it? We're getting close towards the afternoon PM session. Market trades one more time to consequent encroachment, drops lower, clears up sell side here, trades down into this wick, consequent encroachment. Watch. So this consequent encroachment of that wick here, we trade down into that, and we leave the low there and come right back up into this gap. The sell side and bounce by center efficiency becomes, again, one more time, reclaimed bearish fair value gap, and the sell side here and here is formed. And one more time, they wick it through. This is a stop run. As soon as it did this, that right there, it's over. The rest of the session, they knocked out anybody that's trailed stop losses on shorts from here to here to here to here. That was a run on that liquidity. As soon as that candlestick closed like that, you have every reason to anticipate lower prices. This, at that time, becomes an inversion fair value gap. Here becomes inversion fair value gap. When we ran up here and did this, and we closed here, look what the bodies did. The bodies tell you the story, the narrative. The wicks do the damage. So they kept the body closed below this bearish fair value gap here. Here's the run on liquidity. The bodies are below that fair value gap. So that reclaimed bearish fair value gap, okay? We're running buy side. We're running through it, clearing it, and then as soon as we close below it, what are we seeing here? The bodies have shown you confirmation that this was just a stop hunt. Look for the next PD array as a premium array that you can short on. Rally up, drop down. Rally up, stop hunt. This one, because we trade to a PD array, and look at the bodies here. Okay. Because this run didn't even go to consequent encroachment and it dropped down, all that was a run on rejection. Okay. That up close candlestick, that closing price, that's rejection block. So there's rejection block. It runs up, hits it, clears the rejection block, and then sells off. When it does that, it doesn't need to take out that high because it's anchored to the basis of that fair value gap here, this one. So the logic is they ran it back up to take the bodies out. Remember, the bodies tell you the narrative. The wicks are allowed to do the damage. I don't need the wicks to clear. Okay, I don't need that. But it's selling off here, and it did it right before this big pump up. So the first premium array I can sell short on is this buy sign about sell sign efficiency. Carrying it through the range, it's going to act as inversion fair value gap here. So anything in here getting short is okay. Now, apply what I've been teaching you recently. Same logic now. The fair value gap right before a stop hunt that you clearly can see. Buy side, rallies. What's the fair value gap right before that? This one. My deuce, my deuce, my deuce. runs up. The bodies are telling you what? Lower half, consequent encroachment, no passy, no passy. Where's it going to go? Sell side, take the low out of the day, and then continuously drop. First gap after blowing through it, that's the one you want to trade. You don't want to expect it to go back up into this one. First fair value gap right there, boom. Now, here's for your notes. In a trending day, okay, if we can close below this wick that was inside of the first hour's dealing range, if we can trade on a closing base below that, that sets the stage for lower prices in the afternoon, in the PM session. Here we have the run below that low. So we'll take this off. So that sell side there, it runs through it. In a trending day, after we have broken first hour's dealing range, this is not breaking it. This is them testing it. First presented fair value gap after first hour's dealing range is broken. First presented fair value gap after that, that's the one when you'll sell on. Right there. All right, let's see. We'll start with the wick to wick first. I have to make sure I verify the close. 35 3/4. Open. 35 half. So this one's lower than this candlestick's close. So we have a volume imbalance. So you have to include that. It trades up into it here. Can't even trade to the consequent encroachment. Is that bullish or bearish? While order flow is bearish, this is a signature that tells you it can't even get to halfway point. If you can't even meet me halfway, why bother, bro? See how that works? So it can't even get to halfway. It's exceedingly weak. It's going to go the other direction. Okay. And it trades lower, 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 lower. So first hour's dealing range. Now we can take, watch this low. Okay. Watch this. There's a couple ways you can do it. You can do this, drag it down to that little dotted line, lays right on the low, like that. And that'll give you a projection of where price may go. Okay. So if we know that that's likely to happen, and like say this is the perfect scenario, this is two ranges. It's the first hour's range and then the projection of that down. Okay. So this is like a standard deviation of the range established in the first hour, then projected lower. All right. So what happens if, this is the perfect scenario? You anticipate this as the low that could happen if it's perfect, right? Did it get there? Mm-mm. But here's what you can do. You can take this range and say, okay, I want to be trading with the highest degree of probability, but in the same direction. And you think this is the range that it could trade down to. Okay, what I'm doing is I'm anchoring to the visual low of that rectangle. Okay. Now, because I have that on, I can do this. I'm going to borrow 75. Okay, we'll do 25 here. So 25 would be the lower portion because I drew the fib from the high down to low. So there's your lower quarter. Okay. So this portion here, anywhere in here, is an ideal area to take a close and be content. Or as soon as we get into this, be aggressive about trailing your stop loss. Okay. So what that does is it helps you manage any open position and not allow it to come back and take a lion's portion of the run away from you. Okay. So, like for instance, when we had this drop down in here, rallied up, look where the bodies are stopping. I'm going to show you something in a minute how all this is reacting using the information based on the first hour's dealing range. Just let me see this boring part first. But when it starts to drop off here, you can then trail your stop loss here. And as it breaks lower, 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 you're going to trail your stop loss all through here. Every single time I create a little short-term swing low, or every 3 candles. Every 3 candles. Every time it makes a new set of 3 candles, trail the stop loss down. You don't need swing highs when you do that. 1, 2, 3. Okay. Your stop loss would be above the last 3 candles high. And then when it creates another 3 candles, 1, 2, 3. Okay. When it breaks lower, your stop loss would be dropped down just above this high. Just keep a running range that's dynamic on a 1-minute chart or whatever time frame you're using. And what that does is it allows you to strangle the unrealized profit. And then if you get stopped out, you're done. Just walk away. And that would happen where you get stopped out. It would be somewhere in this area here, probably on that candlestick, or if not that one. So you wouldn't have got out at the exact low because you're trying to get to this low as a perfect scenario, but you're getting stopped out in the direction of the run continuously moving, but not giving back the majority of the run. Okay. Sometimes when you see me trading and you'll see me do partials after there's been a short term little turn, and it's not me getting stopped out, I'm just doing a partial and it looks like I'm taking a partial on an up close candle. I'm using the logic of watching that rule I just gave you, which is 3 candles, the highest high in those last 3 candles. That's where your stop loss would be. You're not doing that in every trade. You're doing that when there's a condition like this where the probabilities of it, jerking and changing gears and going against you real quick and not getting to your target, it helps you frame a logic of trailing the stop loss tight and being okay and happy if it stops you out and not worrying about it. Otherwise, you would leave your stop loss up here and let it try to go to it, but it's not in those kind of conditions right now. We have a lot of tomfoolery, a lot of unrealized ranges or targets because there's a failure to launch, trying to get to these objectives because it's very difficult market conditions. All right, so let's make this a little bit more fun. First hour's range here to there, and we'll drag it down so it's laying over top of it like that. So what I did was I laid that 50% level right there at that low. Now I'm going to go into the fib settings. I'm going to add all of the octants. So here is the first hour's dealing range. Okay, and that low is the low of it. That's that little false break below it, and then back into the range we went. Look at the retracement here. It can get to the first percent of fair value gap, but it can get to the upper octant. So it drops down. We use the high of this candlestick here. It's using this quadrant, upper quadrant there. Sells off, works around in here, works around in here, back into the gap. Manipulation. So when we see things run that's not laying on top of an octant or quadrant level, because that's the basis of a key level. If you're seeing things happen in price action and it runs where it doesn't make sense and it's not on or trading to an octant or a quadrant level, it's manipulation. That's what this is. That's what this is. Okay. Here we're using the middle of that little wick there, consequent encroachment here, back to the midpoint level, uses it perfectly there on that candle. Let me show you. See how that candlestick's high right here is riding along this level? See how that gap stays there and didn't get worked at all? Why? Because it's the break through it first presented after that on a trending day. That's the one you want to trade. That's the one you want to dogpile in on. We trade down to this octant, move lower to the next quadrant, lower 1/4%, back up to octant, trade down, work around that lower quadrant. Look at the bodies. Look at the bodies. What are they doing? What is this? What kind of artifact is that? This right here, this is proof. Proof unequivocally. This is absolute proof. There is no algorithm, bro. Look at this. The body's staying right there on that lower quadrant, on a range that didn't exist yet. Remember, these levels, as soon as you get the first hour's dealing range, you can project these levels and then watch how the day uses them. As soon as I get the first hour's range, I'm writing that down. I'm seeing, okay, this is the level I'm anticipating. I'm looking at time and price. I'm looking at time and price. Looking at time, then price. Okay. So using this logic and then not getting down to the lowest low, couldn't get to it here, but we're in the last few minutes of trading. Using these types of things help me forecast. They help me weigh the strength or the weakness of a price run that I may be a part of or anticipating. And if I'm calling out levels, if I'm tweeting something like watch this level, watch that level, many times they are in agreement with these types of things and liquidity. So if there's a pool of liquidity that lines up with one of these levels using the first hour's dealing range, okay? But the first hour's dealing range is very, very beneficial when you know what you're looking for. I.e., an example, how I was outlining this very thing here before it happened. And I told you because we closed below this wicks consequent encouragement, that sets the stage for lower prices in the PM session. I told you I wasn't interested in doing here because I wanted to see what it does for the afternoon. And I gave the criteria that tells me if the afternoon was going to be bearish before the afternoon started. Okay. Again, bending time and space.